Imagine you have 1 crore rupees. What do you do with it? For generations, the answer was simple. Buy property. It's safe, tangible, and you can rent it out for steady income. But what if there's a smarter way? One that could double your monthly income with less hassle and more flexibility. Here's the showdown. Invest 1 crore in property, or put it in mutual funds and use a systematic withdrawal plan, SWP. Let's look at the numbers. A property in a major city might fetch you a rental yield of just 2 to 3% per year, about 16,000 to 25,000 rupees per month. But invest that same crore in mutual funds. Withdraw 6% annually via SWP and you could get 50,000 rupees per month. That's a huge difference. And it's not just about money, it's about effort and freedom. Property means brokers, tenants, repairs, paperwork, a part-time job. Mutual funds manage everything from your phone with a few clicks. The real question, which option gives you a better life while your money works for you? Let's break down the data, risks, and lifestyle impact of both. Ready to challenge old beliefs? Let's begin. Owning property is an emotional dream, stability, and success. But the numbers tell a different story. Rental yields in top cities are just 2 to 3%. And after taxes, maintenance, and vacancies, your net yield can drop below 2%. That's less than a savings account. With far more effort, key rental property risks: unreliable tenants, costly repairs, vacancies, legal hurdles, and rising costs can quickly erode profits and cause stress. Property appreciation? It's slowed. Average growth is 5 to 7% per year, and high transaction costs eat into gains. Finding tenants. One landlord said, "Tenants will surprise you. One big repair can wipe out months of cash flow. Handling repairs and legal hassles make property anything but passive." The dream of easy rental income often turns into a stressful, hands-on business. Vacancies mean no income, but costs continue. Even short gaps hurt annual returns. For most, property is not the effortless investment it's made out to be. The reality: low returns, high effort, and plenty of headaches. Landlords must follow strict laws and codes. Non-compliance can mean fines or forced rent cuts. Is it worth it? Unexpected expenses, insurance hikes, or over-leverage can strain finances and lower margins. While property has many risks, there are a few smart situations to buy. Here's when it can make sense. 1. If you find a property at half the market price, like urgent sales, auctions, or court cases, you can resell for profit. 2. If your rent is at least 80% of a home loan EMI, you could own the property for free in under 5 years. 3. If you can buy a legally clear property with just 2 to 3 months of your income and you can visit it often, or it's secure from encroachment and squatter. 4. If rental yields in the area are 6% or more each year, the investment can beat most alternatives. 5. If you have verified insider info about big upcoming infrastructure projects nearby, you might see strong price growth. In these rare cases, buying property can be a smart move. But always check the risks and do your homework. Now, let's talk mutual funds. They pool your money with others, investing across stocks and bonds, instantly diversifying your risk. A professional fund manager handles everything. The real game changer? The systematic withdrawal plan, or SWP. Set it up once, and a fixed amount, say 50,000 rupees a month, lands in your account automatically. Historically, a balanced mutual fund portfolio has delivered 12% returns per year. Withdraw just 6% annually, and your capital keeps growing even after withdrawals. SWP is flexible. Change, pause, or increase your withdrawals anytime. Need cash? Redeem part or all of your investment in days. No tenants, no repairs, no paperwork. Mutual funds offer growth, regular income, and total control. That's true financial freedom. Let's compare property and mutual funds directly. Returns. Property offers 2% rental yield plus 5 to 7% appreciation, making a total of 7 to 9%. Mutual funds around 12% long term. Liquidity, selling property can take months. Mutual funds, money in your account within days. Effort. Property is hands-on tenants, repairs, paperwork. Mutual funds are nearly passive. Diversification, one property ties up your money in a single asset. Mutual funds spread it across hundreds of companies. Tax, rental income is taxed at your slab rate. Property gains at 20% with indexation. Mutual fund gains are taxed at 10% above 1 lakh rupees and SWP is tax efficient. In every practical way returns. Liquidity, effort, diversification and tax mutual funds come out ahead. The difference compounds massively over time. For most investors, mutual funds are the smarter, simpler choice. Why settle for less? The numbers and the lifestyle speak for themselves. What about those stories of property doubling overnight? Yes, some people strike gold in real estate, but these are rare exceptions, not the rule. For every big winner, there are countless investors stuck with stagnant or unfinished properties. Finding the next hot location takes deep expertise, research, and luck. It's a full-time job, not a passive investment. Why do I believe in mutual funds and SWP? 5 reasons: higher income, better liquidity, minimal effort, more diversification, and total flexibility. I set up an SWP to fund my passion project Moneylands in my account every month, freeing me to focus on what I love.